The next 3 months can make a big difference in your tax bill, but only if you plan correctly and you act before December 31st. The One Big Beautiful Bill Act, signed in July of 2025, has extended some of the previous provisions and made major changes that you need to be aware of. I'm watching many business owners waste thousands of dollars in overpaid taxes because they're not aware of the changes or they're not taking the right steps to effectively optimize their strategy. By the end of this video, you'll have a clear plan on the steps you can take before year end to optimize your tax bill for 2025 and set you up for success into 2026. We're going to cover 7 critical moves, from bonus depreciation to charitable giving strategies and research and development opportunities you definitely need to be aware of before year end. And make sure you stick around because it involves a new floor that was introduced as part of the bill that many accountants are not talking about and could completely change your approach to charitable giving. If you want to stay ahead of these changes and never miss strategies like these, make sure you hit subscribe because every week we're sharing financial insights and recommendations specifically tailored to business owners with revenue of $2 to $20 million. Okay, so why does this matter right now? The One Big Beautiful Bill Act, signed in July of this year, made permanent some of the 2017 Tax Cuts and Jobs Act provisions. It also made changes effective 2025, with major changes coming in 2026. This creates a unique planning window for the remainder of this year. Most business owners are making one of 2 mistakes right now. Either they're completely unaware of these changes, or they're assuming that because the One Big Beautiful Bill Act extended many of the previously favorable provisions, that they can just continue business as usual. But the truth is that both approaches could cost you thousands. Instead, we recommend taking a strategic approach to your tax planning that considers the current provisions of 2025 and sets you up correctly for 2026. Let's break this down into 7 actions you should consider before end of year. First, you should project your income and tax bracket. Before you make any tax moves, we recommend you project your personal and business tax income for 2025. This isn't about just knowing your numbers, it's about having the foundation for strategic positioning. The One Big Beautiful Bill Act makes permanent the low individual tax rates we've enjoyed since 2017, but there's still big benefits in understanding what tax bracket you're going to fall into. If you're on the edge of a bracket, even small moves can make big changes in your tax bill. For example, if your projected income puts you in the 32% tax bracket, deferring even $10,000 into 2026 could save you $700 in taxes alone. On the other hand, if 2025 is going to be a low income year for your business, you might want to accelerate income into this year when your tax bracket is low. This projection isn't just about this year's taxes. It can help you determine if you should accelerate deductions in 2025 or potentially save them for 2026 when they may be more valuable. And speaking of valuable deductions, wait until you see how this all connects with a charitable giving strategy we go over in point 5. All right, if you own real estate, you're definitely going to want to pay attention to these next 2. First, bonus depreciation is back. Under the new bill, 100% bonus depreciation is back for qualifying property placed in service after January 19th, 2025. This is a huge change because under the original Tax Cuts and Jobs Act, which was the bill prior to this last one, bonus depreciation had phased out to 40% in 2025. Now you can expense 100% of the depreciation associated with business assets in year 1. So if you've been putting off purchasing that new vehicle, equipment, technology, or other qualifying asset, you have an incredible opportunity to make that purchase before year end and write off the full cost of that against your 2025 taxable income. One strategic move we're seeing is some clients pulling planned 2026 purchases into December to capture the immediate write-off against 2025 income. Remember, this only works for newer used property with a recovery period of 20 years or less. But what about Section 179 expensing? Well, that's still available too, but with 100% bonus depreciation back, it may be less attractive for many business owners. But Section 179 still has certain advantages for some leasehold improvements that might not qualify for bonus depreciation. And let me just pause here for a second to say the way you structure your business can dramatically impact the way these depreciation benefits flow through to your personal return. Okay, let's talk about real estate and cost segregation studies. If you purchased commercial real estate in the past few years, or you're planning to before year end, a cost segregation study could deliver massive savings to you right now. Cost segregation is a strategic tool that identifies building components that could be reclassified from real property, which gets depreciated over 39 years, to personal property, which allows for shorter depreciation and potentially 100% bonus depreciation that we just talked about. In many cases, we've seen 25 to 35% of a building's cost get reclassified this way. For example, If you bought a $2 million commercial property this year, a cost segregation study may identify $600,000 in components eligible for bonus depreciation this year. That's a $600,000 deduction this year instead of having to spread it over 39 years. And if you bought properties in prior year but never did a cost segregation analysis, you may still qualify through a look-back study. But for all of these, in order to capture the benefit in 2025, you need to have the study completed before you file your 2025 return. But what if your business is focused more on innovation than real estate? In our next point, I'll show you how the One Big Beautiful Bill Act has created a big opportunity for tech and manufacturing companies producing new products. So let's talk about R&D expenses and credits. The OBBBA brought welcome news to those companies investing in research and development. If you've been capitalizing R&D expenses since 2022, you could have a massive opportunity here. Starting in 2025, domestic R&D expenses will once again be fully deductible in the year they're incurred, no longer needed to be capitalized. But here's the exceptional opportunity. For R&D expenses that you already capitalized between 2022 and 2024, you now have the opportunity to accelerate those deductions. This means you can either amend your prior year returns and claim the deduction then, file a superseding return if applicable, or catch up all of these deductions in your 2025 return. This could be a big opportunity for many businesses, especially when potentially combined with the R&D tax credit. If your business engages in developing new products, software, processes, or improving existing ones, conducting an R&D study could help you claim a valuable R&D tax credit. This credit is a dollar-for-dollar reduction in the tax owed, not just a deduction. Even better, the OBBBA has made this more accessible for small businesses. An R&D study could help you identify qualifying activities that you may be overlooking. And here's something interesting for philanthropically minded business owners. This R&D tax savings could free up cash flow for the charitable strategy I'm about to share next. All right. If charitable giving is part of your tax strategy, pay close attention to this next point. As we've talked about in a previous video, the One Big Beautiful Bill Act has made significant changes to charitable deductions that creates a unique opportunity for planning in 2025. Remember that floor I mentioned earlier? Starting in 2026, charitable deductions are now subject to a floor of 0.5% of your adjusted gross income. This means that any donations beneath this threshold won't be deductible. There will also be a 35% cap on the tax benefit of all itemized deductions, down from 37%. This further limits the value of your charitable deductions starting in 2026. So what should you do if you plan to give to charity? If you're charitably inclined, consider accelerating 2026 donations into 2025 to make sure you maximize the benefit. You'll get the full deduction now that won't be subject to the floor or the itemized deduction cap. If you're planning to give much more over the next few years, consider setting up a donor-advised fund or a DAF. This gives you the full deduction now with the flexibility to donate to charity over the next few years. This charitable planning strategy becomes even more powerful when you combine it with an estate planning strategy, which we'll go over next. All right, so the One Big Beautiful Bill Act has significant changes for estate planning. In 2025, the federal estate tax exemption is set at $13.99 million per person, or nearly $28 million per married couple. But here's what makes this a time-sensitive opportunity. These historically high exemption amounts are not permanent. While the Act has made many provisions permanent, it hasn't fundamentally changed the scheduled reduction in estate tax exemptions. For wealthy business owners, this creates a use it or lose it situation for potentially millions of dollars in exemptions. Strategies like establishing irrevocable trusts, family-limited partnerships, or direct giving can all be considered before year-end to lock in the exemption amounts. Even if your net worth is below these amounts, the Act offers planning opportunities for succession and legacy planning that shouldn't be overlooked. And this brings us full circle to one of the most fundamental decisions a business owner will face that will impact their tax strategy. Let's talk about reviewing your entity selection. With all these changes, now's the perfect time to reevaluate whether your business entity selection still makes sense. The One Big Beautiful Bill Act has maintained the 21% corporate tax rate and the 20% qualified business income deduction for pass-through entities. Remember how I mentioned earlier that your business entity selection can impact whether or not you can take certain deductions such as bonus depreciation on your personal tax return? Here's where it all comes together. Your entity choice affects how bonus depreciation benefits you personally, whether R&D credits offset your personal or your business taxes, how your charitable contributions are deducted, the tax implications of your estate plan, and most importantly, the total amount of tax that you pay when you consider both your business and your personal activities. Depending on your specific situation, converting from an S Corp to a C Corp or vice versa may make sense. Other options like partnerships or sole proprietorships may be the best way to optimize your tax situation. Of course, this isn't a one-size-fits-all decision. You should carefully consider your projected income and growth trajectory, your distribution needs and cash flow requirements, your long-term exit or succession plans, and of course, potential future tax law changes. The next 3 months is an ideal time to have a conversation with your tax advisor about entity structure because entity changes often need to be made before the year end to be effective. All right, let's recap. With less than 3 months in the year, here are the steps you should take to optimize your tax position. First, schedule a meeting with your tax accountant as soon as you can. Bring your year-to-date numbers and your projected Q4 income. Create a prioritized list of potential equipment or real estate purchases you've been considering, along with estimated costs. If you purchased real estate in recent years, talk to your accountant about whether you should consider a cost segregation study and if the potential tax savings outweigh the cost. If your business is engaged in innovation, organize all of your R&D activities from 2022 through 2025 to evaluate both the deduction acceleration opportunity and the potential R&D tax credit. Next, review your charitable giving plans for the next 12 to 36 months. Based on that, determine whether accelerating donations into 2025 makes sense or if you should even consider setting up a DAF. Now, for high net worth business owners, schedule an estate planning review to make sure you have everything optimized and you're not spending more than you should in certain areas, and you have the protection you need. Lastly, work with your accountant to analyze your entity selection. Make sure your current entity works best for you for now and for the future. The key is to analyze quickly. Many of these strategies will take time to implement and execute. Waiting until December could mean missing out on significant opportunities. And remember that income projection from step 1? That's the foundation that makes all of the rest of these strategies work effectively together. Without a clear picture, you're effectively planning in the dark. All right, so today you've learned 7 critical year-end tax planning strategies for 2025. Projecting your income, maximizing bonus depreciation, analyzing real estate investments, capturing R&D opportunities, optimizing charitable giving, estate planning considerations, and reviewing your entity structure. Your homework? Reach out to your accountant and schedule that tax planning meeting now. Don't wait until the year end to get this done. We're working with our clients over the next couple months to make sure they're set up for success going into the end of the year and for 2026. This isn't a single conversation. We're talking multiple times before the year is over. I hope that you found this video valuable. If you found it helpful, please hit that subscribe button. We're going to keep giving business owners like you actionable financial steps every week. And if you have questions about any of these specific steps, ask a question in the comments below or go to the link in the description and reach out to schedule a call with us directly. Talk to you soon.